Hello everyone, and welcome back to Web3 Daily, where we dive into the latest market dynamics. To be honest, when I first looked at the charts this morning, my initial thought was that things felt a bit flat. Bitcoin and Ethereum prices seemed to be treading water, and the whole market had a sleepy vibe. But if you dig into the data, you'll see it's not that simple. While prices haven't moved much, the overall trading volume has been quietly picking up, and the total crypto market cap has actually increased by over 1.4% in the last 24 hours. Now, that's interesting. The price is stable, yet money is flowing in and the trading is becoming more active. What does this tell us? I get the feeling that beneath this calm surface, there's an undercurrent at play. Big money hasn't left the scene. It's quietly reallocating, rotating out of some major coins and into other sectors with more potential. The entire market feels like it's at a crucial crossroads, holding its breath and waiting for the next clear signal to pick a direction. Just when the market's direction seems uncertain, a payments giant from outside the crypto world is making a huge move, and I think this could be one of the key catalysts that ignites the next market cycle. That giant is PayPal. Yesterday, PayPal officially launched a new feature called PayPal Links, which is essentially a peer-to-peer payment system that supports cryptocurrency. You can think of it as a Web3 version of PayPal. Users can generate a personal link, share it via text, email, or social media, and instantly receive or send payments in Bitcoin, Ethereum, or even PayPal's own stablecoin, PYUSD. The most crucial part, peer-to-peer transfers are completely free, and for users in the US, there's a massive hidden benefit. These personal crypto transfers don't need to be reported to the IRS, which means no tedious tax filing headaches. My first reaction to this news was that this is far more than just a simple feature update. This is a grand strategic play by PayPal. On the surface, they're making it easier for users to transact with crypto. But the real core strategy here is to aggressively promote their own stablecoin, PYUSD. Just think about it. A payment platform with hundreds of millions of users suddenly allows you to send and receive stablecoins as easily and frictionlessly as sending a Venmo with no cost. What a massive use case that creates. This directly solves the last mile problem for crypto payments. What PayPal is aiming for is no longer just to be a simple payment tool. They are building a brand new blockchain-based global clearing network designed to compete directly with traditional titans like Visa and MasterCard. Of course, opinions within the crypto community are divided. On one hand, people are excited about this level of mass adoption, feeling like it adds another engine to the bull market. On the other hand, many are wary of such a centralized solution. After all, assets held in PayPal mean it's not truly your keys, your crypto. But regardless of where you stand, when a behemoth with 420 million users goes all in on this track, every single one of us needs to pay very close attention. PayPal's strategy is focused on the long term, but Wall Street's hard cash isn't waiting around. Let's turn our attention back inside the crypto space and look at the spot Bitcoin ETFs, where the recent capital inflow can only be described as fierce. In just the last 4 trading days, a cumulative total of over $928 million has flowed into these ETFs. What does that mean? It means that Wall Street institutions have been scooping up Bitcoin at a frantic pace, to the tune of over $200 million per day. As expected, the ETFs from giants like BlackRock and Fidelity continue to be the main attractors, capturing the lion's share of these new funds. I've noticed a very interesting phenomenon here. At the same time that Bitcoin ETFs are aggressively pulling in cash, some Ethereum-related investment products have actually been experiencing outflows. What this could reflect is a strategic rotation of institutional capital. It suggests that the big players are no longer just asking, should we buy crypto, but are thinking on a much more granular level. At this specific point in time, should our capital be allocated to Bitcoin or Ethereum? And clearly, based on the recent data, the institutional scale is overwhelmingly tipped in favor of Bitcoin. This capital rotation from Ethereum to Bitcoin not only solidifies Bitcoin's status as a digital gold and a safe haven store of value, but it also indicates that in the face of ongoing macroeconomic uncertainty, institutional investors prefer to cling to the asset with the strongest consensus and best liquidity. So, while the market price hasn't moved much, the exchange of chips beneath the surface has become incredibly intense. While Wall Street institutions are seizing control of Bitcoin's pricing power, our old friend in the retail space, Robinhood, hasn't been sitting idle. They are no longer content with just being a platform for trading stocks and crypto. They're preparing to take their tens of millions of users into a capital game that was previously reserved for top-tier venture capitalists. Robinhood has officially filed with the SEC to create a new fund called Robinhood Ventures Fund I. So what does it do? Simply put, it's a venture capital fund aimed at ordinary retail investors. It will invest in private, pre-IPO companies, and the filing explicitly states that this includes startups in the Web3 and blockchain space. The significance of this move, in my opinion, is quite profound. For the longest time, venture capital has been an extremely high barrier to entry field, a game for Silicon Valley elites and the ultra-wealthy, with no access for the average person. What Robinhood is doing now is tearing down that wall, effectively democratizing venture capital. This means that in the future, you might be able to invest in the next potential industry giant at its earliest stages, right from the Robinhood app. Of course, high potential returns come with high risks, that's a given. But behind this move is a clear and open strategy from Robinhood. In an era of ever-decreasing trading fees, a simple brokerage business model is no longer enough to retain users. By offering exclusive early-stage investment opportunities, Robinhood can not only significantly increase user stickiness, but also elevate itself from a simple trading tool to a comprehensive wealth management platform. This is also a potentially huge positive for the entire Web3 industry, as it opens up a brand new fundraising channel for innovative startups, giving them direct access to a massive user base. Alright, after covering those serious moves by institutions and retail platforms, let's shift to some news that's a bit more lighthearted, but just as significant. Honestly, this development feels a bit surreal. Dogecoin, the asset that was born from a joke and became a global phenomenon thanks to a Shiba Inu meme, has now officially made its grand entrance into the US capital markets. It now has its own legal, regulated exchange-traded fund. You heard that right, the very first US Dogecoin ETF has officially begun trading under the ticker DOJE. In my view, this news marks the beginning of a new era. An era I'd call the financialization of culture or the assetization of consensus. An asset driven purely by community consensus and internet memes has now been packaged by Wall Street into a traditional, compliant financial product. This allows conservative capital from investors who might not even know how to use a crypto wallet to indirectly invest in Dogecoin. The signal this sends is that the traditional financial system is beginning to recognize the value of narrative and culture as an investable asset class. If even Dogecoin can get an ETF, could other meme coins with strong communities, like Shiba Inu or Pepe, eventually follow the same path? This effectively opens up a brand new, compliant gateway for capital to flow into the entire meme coin sector. While it might not have an explosive short-term impact in the long run, this undoubtedly raises the valuation ceiling for the entire meme coin category by a significant margin. While Dogecoin's move into compliance represents the crypto world breaking into the mainstream, a different kind of race is quietly accelerating in the core heartland of DeFi, a race to build its foundational infrastructure. This time, the protagonist is the stablecoin giant Circle. Circle recently announced a very deep partnership with Hyperliquid, a high-performance decentralized exchange that has been rapidly gaining traction. Now, this isn't just a simple asset listing, it's a multi-layered collaboration. First, Circle will issue native USDC on Hyperliquid's Layer 2 network, HyperEVM. Pay attention to the word native. This means it's not a wrapped asset from a cross-chain bridge, which results in higher security and capital efficiency. Second, Circle will deeply integrate the latest version of its cross-chain transfer protocol, CCTP v2, into the platform. You can think of CCTP as Circle's version of the SWIFT system for the Web3 world, allowing USDC to move seamlessly and securely between different blockchains. Finally, and this is the strongest signal of their commitment, Circle has also made a direct investment in Hyperliquid's native platform token, HYPE. When you put these three actions together, the message is crystal clear. This is not a routine business partnership, it's a strategic alliance. In the fierce stablecoin wars, Circle's strategy is moving beyond simply competing on the size of its reserves. Instead, it aims to embed its USDC like a circulatory system into the most active, high-frequency DeFi trading environments, positioning it to become the indispensable base layer settlement network of the DeFi world. Through this combination of investment and deep technical integration, Circle is turning Hyperliquid into a showcase, demonstrating to everyone what the future of the most efficient DeFi ecosystems will look like. While the native giants of DeFi are rapidly evolving, the behemoths of the traditional financial world aren't slowing their entry for a moment. This time, it's the turn of the European banking giant, Santander. Open Bank, Santander's fully digital banking arm, has officially launched cryptocurrency trading services in Germany. Now, Open Bank customers in Germany can buy, sell, and hold Bitcoin, Ethereum, and other major altcoins like Cardano and Polygon, all with a single click inside their familiar banking app. When I saw this news, the first phrase that came to my mind was customer retention war. The calculation that traditional banks like Santander are making is actually quite simple. They see very clearly that their younger customers are flocking to crypto-native exchanges like Binance and Coinbase. Rather than just watch their clients and capital leave, they've decided to get in the game themselves, incorporate crypto into their own ecosystem, and transform their banking apps into one-stop financial supermarkets where you can invest in anything. Of course, a key enabler behind this move is Europe's clear MiCA regulatory framework. This legislation has given traditional financial institutions the confidence and clear rules they need to embrace crypto assets. While their trading fee of 1.49% is considerably higher than what you'd find on an exchange, and their asset selection is limited, they have a massive advantage, a huge existing user base, and the trust that comes with their brand. For an average person just looking to dip their toes into crypto, buying it within their trusted banking app presents a much lower psychological barrier. After this pilot in Germany, Santander plans to expand the service to other core markets like Spain. So, make no mistake, this isn't some small experiment. This is a formal offensive by traditional banking into the core territory of crypto exchanges. While European banks are on the offense, companies in Asia are embracing Bitcoin in a more aggressive, faith-driven manner. If you remember MicroStrategy's playbook of essentially turning the company into a de facto Bitcoin ETF, well, a publicly listed Chinese company is now preparing to replay that script, but on an even grander scale. The company is Next Technology, holding a Shenzhen-based firm that is, based on public records, the largest corporate holder of Bitcoin in China. They recently announced a stunning plan. They intend to sell $500 million worth of company stock, and all the capital raised from this sale has one single purpose: to buy more Bitcoin. This move, in my opinion, is an incredibly strong signal. It marks the successful replication and amplification of the MicroStrategy model, but this time, in the East. This company isn't gambling blindly. According to public data, their existing Bitcoin holdings have already generated an unrealized profit of over 269%. This new $500 million investment is a decisive doubling down on a strategy that has already proven to be a massive success for them. From a market perspective, this means a new powerful source of support is emerging on the demand side for Bitcoin. This type of buying pressure from public companies is different from ETF inflows. ETF flows can be influenced by short-term market sentiment, but companies like Next Technology and MicroStrategy are treating Bitcoin as a core treasury reserve asset, making strategic allocations intended to last for years, if not decades. This kind of long-term, continuous, large-scale buying has an immeasurable effect on stabilizing Bitcoin's price and absorbing selling pressure. You could say that, following retail investors and institutional ETFs, the balance sheets of publicly traded companies worldwide are now becoming the third giant pillar supporting Bitcoin's value. Alright, that wraps up today's Web3 Daily Report. If you found this helpful, please remember to hit the like button to show your support. Every day, we sift through the noise to bring you the most critical and actionable insights from the Web3 world, the news closest to the money. We hope that by breaking down these curated stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've prepared exclusive registration links for major exchanges in the description below. These links come with special high rebate bonuses that we've secured for our viewers, and we hope they can help you save on some costs along the way. Let's all stay rational, move forward steadily, and get rich slowly here in the world of Web3. May everyone's crypto assets grow consistently. We'll see you tomorrow.